Welcome back to another episode. Today we're going to take a quick look at four of the giants, where they're at right now, how stock prices have been performing, and just my overall thoughts. And we can see today is definitely not a good day. I mean, if you don't have to, we recommend days like today are days where don't look at your portfolio, just walk off and do other things, right? In the short term of things, for example, Amazon right now is down 3.4% as I am recording. In the past 5 days, it's down over 8%, and in the past month, it's down over 11%. Even in the past 6 months, it's down almost 20%. So right now, we can see it's definitely a scary time for all types of investments, right? And this is why I want to say it's always important to kind of have that long-term mentality, right? 6 months have definitely sucked. But 6 months, even in the market, is still very, very short time, especially if you're someone like me who's just kind of, even though I've been investing for numerous years, it's still in my early stages. I'm not planning to use this money for multiple years from now. So I want to say, if you are in the younger base of investors, I do want to say it might suck right now, but these might be opportunities that can kind of shift your overall financial future if times like this don't scare you off from investing. As an investor, obviously it sucks seeing portfolio down, but by no means am I worried. I continue my weekly investments because I believe the prices I'm seeing now are gonna be way cheaper compared to the prices I'm gonna be seeing in 5+ years when I might need this money. So I just wanted to share off, kind of talk a little bit more about mindset investing before taking a quick look at the 4 stocks today. If this is your first time here, make sure to hit the thumbs up, make sure to hit the subscribe button, check out the pinned comment for free Discord, free newsletter, and a lot of great investing links. So the 4 stocks we're gonna take a quick look at today are gonna be Amazon, Microsoft, Alphabet, aka Google, right? Am I the only one who still calls it Google? Right now, Amazon is down over 24% from its all-time highs. Microsoft is down over 18%. Alphabet is down over 14%, and Apple is down over 10%. And let me just say, just by looking at all-time highs, I don't believe that maybe these all-time highs will come anytime soon. The last thing I want to do is kind of price anchoring that, hey, this is the price we're gonna get soon. But what it tells me is that, hey, a good portion of risk has been eliminated, right? Because now those kind of high valuations that we've seen in the past are obviously there can still be some risk there, but that risk has dramatically decreased. If we take a quick look at PE ratios forward 1 year for all of them, I want to say they're all looking kind of interesting. To me, the ones that look the most interesting, I would say, is the Alphabet Google PE ratio forward, which is about 18.87. Alphabet usually trades for some form of discount for numerous reasons: heavy regulations, a lot of risk with kind of privacy and stuff like that. So Alphabet to some extent usually trades for a discount, but still, I mean, this is a monster. You're most likely watching this to YouTube. If you don't have YouTube Red or whatever it's called, Premium, you're most likely watching ads which help fuel this company's revenue. Amazon, like I mentioned, it is lowest compared to where it's been. We're going to take a quick look at growth. Maybe it might not be growing to the extent it was before, but like I mentioned, I don't believe it's anywhere near game over for Amazon. Let's take a listen to today's sponsor. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You guys know I love finding new investing tools and resources to help me scout out new growth stocks. And right now I have a discount for one of my favorite services The Fool offers. Through the Motley Fool Stock Advisor services, you get access to a ton of expert stock picks. Every month you'll get 2 new picks that are aimed at growing your wealth and to help you realize your financial goals. Stock Advisor's average stock picks have done amazing returns. If growing your money is something you'd like to do more of this year, you can visit fool.com/Jose Najarro or click on the link below for access to my special offer and decide if the stock advisor is right for you. Thanks again to the Motley Fool, and now onto today's video. Now, if we take a look at quarterly year-over-year growth, this is why I really enjoy Google. I think Google is my favorite out of the 4. It's had lowest PE ratio. It also has had kind of the highest quarter-over-quarter growth. In the most recent quarter, it grew 32%, followed by Microsoft that grew 20%. Apple grew about 11%, and Amazon, unfortunately, has been the slowest one that only grew 9.4%. But Amazon, same time last year, right, we can see this kind of trend, 2020, 2021, were huge growth rates for Amazon. So right now, we're kind of seeing those kind of harder to kind of compare to previous years because of the strong strong growth. So I think this is one of the reasons maybe investors are kind of fearing Amazon, and why we see that 25% cut on their all-time highs is because investors might be saying, hey, this is no longer a growth story, but it kind of took a nice amount of growth in the past year. So it's understandable. Like I mentioned, year over year quarterly growth is seen very attractive for me for Google. I mean, advertising is going to continue. Obviously, with talks of inflations, there's going to be businesses that are going to cut down on advertising. So in the short term, there's definitely that kind of risk that people might not advertise as much because they don't want to spend as much money with everything else increasing in price. I do want to say though, as one company goes down, another company does kind of rebuild or start up. So for me, the advertising business is one I do enjoy. Now I also want to take a quick look at future revenue growth. Again, Alphabet is top of the list here, expected to grow 22%. Microsoft is second, again, expected to grow 17.5% in this upcoming quarter. Amazon and Alphabet and Apple are expected to grow in the single digits. So we can see it's going to be another kind of not high growth story for Amazon. But we're going to see some of the things I really enjoy about Amazon. Maybe some investors might kind of be forgetting about. So next, if we take a quick look at cash flow from operations trailing 12 months, we can see all four of these businesses make a lot and a lot and a lot and a lot. And I can probably say that a lot more times of cash. We can see a beast here comes in with Apple being the number one, making 112 billion cash flow from operations. Next is Alphabet with 91. Historically, we've kind of seen this kind of growth rate, except Amazon. I want to say Amazon is focusing a little bit more on some other type of growth strategies. So that could be a reason there. But historically, all strong cash flow from operations. And if we also take a quick look, all these companies have a nice amount of cash in their balance sheet that allows them to do a lot of things. When you have a lot of cash, it allows you to take risks. Some of those risks are making acquisitions. Some of those risks can include building new forms of technologies that might not be in the market right now and could kind of be a risky investments. When you have strong cash flow, when you have strong cash balance sheet, it allows you to take those risks, and some of those risks can pay off really, really well. So I'm happy with all the balance sheet. Apple tends to have a lot of long-term debt for other reasons, but still, for me, again, Google, Alphabet, whatever you want to call it, and Microsoft are two of my favorites right now. And I want to say those are the two that I do have in my portfolio. But Amazon is definitely looking attractive to me. So now, kind of we saw their metrics. I want to mention a little bit why I'm excited in each of these companies, even if I don't own them. With Google, obviously, there's two things. First, I want to say YouTube ads. YouTube ads continues to grow, and I don't see this going anywhere right in the near future. I think content creators are going to continue to come to the platform. The second is going to be Google Cloud. Unfortunately, Google Cloud is not profitable for Google, but it is growing at some impressive levels, and I do believe in the near future this would also be a strong player. Now, if we take a quick look at Amazon. Amazon is one I don't have, but two things I really do enjoy. Actually, three. There's three. First is advertising services. Advertising services, most recent quarter, made over $9.7 billion. That's more money than Google made in YouTube, right? So the advertising business is still growing at strong levels and is making strong amounts of money, and I can see this kind of continue to grow because Amazon has so many different services. They have music service, live streaming service, they have the videos, Twitch, they have the e-commerce, they have Audible. So all these services are great at places where they can advertise heavily. The second I want to say is AWS. Obviously, clouding market is still pretty impressive. In the most recent quarter, it grew 40%. And then the third one I want to say is it's the subscription services. Again, I mentioned numerous subscription services that Amazon has. Most recent quarter grew about 16%, and it is starting to kind of creep up there with over 8 billion in the most recent quarter. So all of these right now, obviously compared to e-commerce, is still a small portion of revenue, but I do believe these are ones that can provide strong margins and strong returns in the future for Amazon. Now, if we take a quick look at Microsoft, for me, Microsoft, two biggest things. First is the cloud basis. For example, Azure and other cloud service revenue grew about 46% in their most recent quarter. The second thing is I do believe Microsoft is one to reckon in the gaming market, and they have very heavily investing here. For example, the overall plan to acquire Activision Still gonna take some time. I wonder if this is gonna go through, but if they do, Microsoft is gonna be a strong player in the gaming world. Apple, one of the things is Apple is heavily tech, I want to say tech hardware, and they have a nice amount of engineers innovating this. I do believe in the upcoming quarters, Apple can kind of produce cool products in the virtual reality and augmented reality market. And if there's any company that can ever bring AR and VR mainstream, I think it would be Apple. And I do believe that's huge optionality for Apple and one of the potential heavy growth that this company can see. So overall, I do want to say I hope you guys enjoyed today's episode. If you did, make sure to hit the thumbs up. And remember, market is scary, but these are times where, as an investor, especially a long investor, we should be seeing it as an opportunist time where we want to increase some of the portfolio positions that we wish we would have increased in 2020 and 2021. So I hope you guys enjoy. Take care. Have a good day and see you next time.